Derek here, rural investor. Disclaimer, for entertainment purposes only, not financial advice. Please do your own due diligence and consult any financial professionals as you see fit. Crazy week again. I think we're minus 26 with the wind chill tonight, so I actually have my heater on. I kind of wussed out a little bit tonight, but it's probably okay at minus 26. I think I'm ready to talk about actually using margin, how it goes with income investing, or at least the income investing that I do, and the two different ways in which I go about using margin. One of the first videos that I went over, if you're new to the channel, which hopefully most of you are, was how I didn't think financial advisors understood this type of investing to the level where they knew how to suggest it to people. I've talked to a number of them. I know a few financial advisors, from high school, a couple through college. I know some people I work with who know people that work at the big banks. One of them is JP Chase, who actually has a couple of funds that I don't purchase, but they do this type of investing as well. Financial advisors are encouraged to do stuff that is safe, that is sort of generic, that gets a lot of assets under management, AUM, to drive their revenue, right? It's good for them to have you invested with a lot of money for a long time. And the type of income investing that we talk about on this channel doesn't align with that. And so right there, you're sort of at odds with what we want to do on this channel and what makes them money. And since this is financial, to me that's a problem. In my life I've been pretty good at solving problems, and so I looked around and said I want to run a homestead, and I want to do it while I'm younger, and I want to enjoy it with the kids, and I don't really want to travel for work. How do I go about doing that? And through a bunch of trial and error, we came to this place here of these covered call ETFs. And I have some other things that we haven't talked about yet, but they're high yield, right? So let's call these high yield income investments. And I've learned a lot about them. Traditionally, margin is considered risky. Margin is when you borrow against your stocks to buy more stocks than you could afford out of your own pocket. And I think that can be risky if you're focused on growth. If you owned Microsoft this week and you're down 15-20%, if you owned Amazon and you dropped 15% in a day, 5% during the day, 10% after hours when they announced earnings, and you're leveraged, which is what it's called, you're just down, right? You have no way to recoup that until the stock price goes up. That's not true for high yield income investing, especially when you're buying quality assets like Microsoft and Amazon. They're covered call ETFs that yield 20% or so, right? When we go down 20%, our income goes down 20%. But that means we're still getting paid out 80% of what we expected to get on that initial investment. And that's enough to cover both the cost of the margin, I use Robinhood at 4.5%, plus still be profitable. And so I sat back and I went, well, this is absolutely like running a business. If you run your own business, I'm sure you're aware that things are seasonal. Not just seasonal, but up and down. You might have a big job, then no job. You might own an excavator is the tool that I keep using, because that thing could sit unused for months, and then all of a sudden it's worth a $50,000 dig a foundation job for a barn that somebody's putting up. But you had to make those payments every month, right? But you own that machine to bring in income. You didn't own that machine to go up in value. And so the more jobs you do, the more wear and tear you put on, the less it's worth, but the more money you make. And that's exactly how high yield investing for income goes with margin. If I have $10,000 and I open up a Robinhood account, for me, Robinhood will give me $1 for every dollar I put in. So I have $10,000 for myself, and then Robinhood goes, hey, I'll give you another 10 grand. You got to pay me 4.5%. And I go, that sounds like a pretty good opportunity. I'm going to take my 10 grand and I'm going to go stick it. We'll keep it simple. I'm going to go Maggie, because the Magnificent Seven are Funny enough, about half the price of Walmart stock, which is going to grow 3 to 4%, and the Magnificent Seven are projected to grow mid-teens. So we'll talk about that in another video if it holds true for a couple of weeks. I'm going to go stick my 10 grand in Maggie. Pays me 35%. I'm borrowing at 4.5. It means I got 31.5 points of safety. That's an absolute slobber knocker of a business to run. I can watch Magnificent Seven go down by half, and I'm still making money hand over fist. Yes, my net worth went down, just like the value of your machine would go down. But I'm not selling the machine. The machine is there to generate cash flow and profits. And Maggie is going to do that down 50%. I don't have to worry about it coming back. As far as I'm concerned, it can stay flat for the next 20 years, and we're going to be profitable by doing this. And so I make the full amount on my 10 grand, then I juice myself by that 31.5%. And again, if it goes down by half, if it goes down by 3/4, I'm still profitable. So once I realized that, to me, it really took most of the risk away from margin. What's the real risk with margin? It's margin calls. Well, why do I invest with Robinhood? Because they have what's called a maintenance ratio, and their maintenance is low. And yes, it can change for those of you who are more experienced with this at any point in time, and Robinhood can go up or down on their margin. I've been doing this for a number of years. Robinhood tends to follow the Fed. If they go down 1/4 point, Robinhood goes down 1/4 point. Fed goes up 1/4 point, Robinhood goes up 1/4 point. I also own an income version of Hood from time to time. When I think it's cheap, I buy it. When I think it's expensive, I sell it. So I'm pretty aware of their financials. And margin is one of the profit drivers and options for them. And so it's in Robinhood's best interest to keep you solvent as well, as far as they're concerned. And so they don't look to jack up interest rates in times of trouble. They don't look to increase your maintenance in times of trouble. They keep it pretty steady over the last, how long have I been using Robinhood? Almost 6 years. They keep it steady for the funds that we're talking about. And the reason for that is if they make you close the position, they don't make money. And I don't know if they do this with the growth funds or not. I know they do it with the high income funds. And to me, it makes a lot of sense because we're still profitable and they're still profitable. And as long as our loans are open, everybody is happy making money. It's a win-win. So that's one way to use margin, right? And you can open up a Robinhood account. You can borrow against the money that you put in. So if you have 10,000, in theory, you could have 20,000 to buy stocks with. Your portfolio value is still 10,000 because it's 20,000 worth of stocks, the 10,000 net plus the 10,000 that you owe on the machine, that is margin. With these funds that we've talked about on other videos have gotten better and better. Again, for those of you new, which hopefully is most of you, the last video I put out because there's a fund manager, actually I think is the owner of Tap Alpha. So they do T-SPY and TDAX, which have been able to compete and in some cases beat their underlines, that's what it's called. And that guy had a similar outlook to me. He was in his mid-40s. He talked about delaying having kids, and I have all this money, but I didn't have the life that I wanted. And he got out of the rat race and created funds to do exactly what we're talking about doing on this channel for himself, because he knew what he was doing, and using his funds is more tax efficient than doing it on your own, and a number of different reasons. And he was 100% right. The reason I talked about that video and encouraged people to go watch it is because here's a professional. He's licensed. He was doing what financial advisors were doing, and he was like, wait a second. This isn't producing the results that I want. It's producing the results that are good for other people. And so what I was trying to do is give the channel a little bit of gravity, a little bit of weight. That it's not just some guy in a garage who has these crazy ideas. There are a lot of people going, this traditional way of investing doesn't work for me. And we have a whole bunch of new products and a new way of looking at things and a new puzzle to solve. And there are a bunch of us that frankly just like doing it. And so Tap Alpha, Curve, and Neos are probably my 3 favorite fund managers. I think they're excellent management. I think their results have been good, generally speaking, for most of their funds. And I think you can't go wrong if that's where you start. So what's this other way to use margin? The other way that you can use margin is to buy a leveraged fund. I mentioned that I occasionally own the Robinhood stock. It's called Hui. It's leveraged 1.2 times. So what that means is if you put in $10, it's like owning $12 worth of the stock. They have leveraged it for you. There are no margin costs associated with that. And so, that's great. So I have $10, I get $12 worth of stock. The issue is that they're more volatile. If the stock goes up, it will go up 20% more. If the stock goes down, it will go down 20% more. But they pay huge yields for this, right? Which is what we're after, that income. If you think that the stock market is going to continue to go up and to the right over 20, 30, 40, 50 years, you should be leveraged when you're investing for income. You should be. Because you're going to have way more ups than downs, and so that leverage will amplify the ups more than it will amplify the downs, meaning you'll make more money. And so I wouldn't recommend, leveraging to the max amount that you can get from Robinhood, and I wouldn't recommend only putting money in leveraged funds because you do want some stability and some safety. But if you're going to invest for income, if you're looking to make this the primary source, I think leverage isn't something that you should think about. I think it's something that you should most certainly do. It's something that I've been doing for a long time. I think it's been magnificent. Yes, I got crushed on some silver, and I got some crushed on, a little bit of my Maggie this past week. But I also bought a crap ton of Microsoft and Amazon income funds from Curve, because those funds, Microsoft is trading at what you'd call a 23 forward PE, roughly at the time of this video. Walmart is trading at roughly a 45 PE, meaning that it is twice as expensive to buy Walmart as it is to buy Microsoft right now, excuse me. And that's a bit absurd. Walmart is projected to go 3 to 6%. The analysts, I think, have Microsoft growing 18%. Microsoft has a boatload of cash. What we saw was a quick rotation over fear of spending on AI out of the companies that are going to benefit from AI, in my opinion. And so I'm leveraged as much as I'm comfortable leveraging, and I leveraged right into Amazon, Google, and Microsoft this week. So just like you'd own that excavator and you would absolutely bid on all the jobs you want, and you would use it, and you would bend your shafts, and you're going to break tracks, it's worth it because you bring in more money the more often that you use it. And so the only thing that I would really caution against is make sure that you understand whatever broker you choose, how much they're willing to give you on top of what you put in, and what their maintenance ratio is. Robinhood has the best maintenance ratios that I have seen. I haven't opened a ton of brokerage accounts, but I've looked into more than 10, and Robinhood is consistently low, which is good for you. One of the other reasons I like Robinhood, I don't want to get too far into this, is not only are their margin rates 25, a lot of companies, I don't want to name them, are over 50%, meaning you take more of the risk on the margin than they do. If they have a margin rate, maintenance ratio of 75%, that means you are 75% of the risk and they are 25. Robinhood reverses it. And what's cool about that is it does something funny with the math. When they take the larger risk, when the stocks go up, it actually can compress what's called your margin of safety, and it might encourage you to sell high. Conversely, if you have a lot of things and things go down and they maintain their margins, which generally speaking they have, it actually protects your margin of safety and allows you to hang on to quality. We're talking about quality ETFs here. Quality ETFs during downtrends where other funds, you start running into those issues with margin calls. And then the other way around this entirely is those 0% credit cards, which I've talked about in other videos. Why do I like them so much? Because they're detached debt. Not only can I borrow for 4%, 3%, right? It's not attached to my asset, meaning that I can manage them separately. My credit cards cannot force me to sell my stocks, unlike margin. And so, I think those are three options. I think if you're into this channel, you're into high income investing to live the life that you want to, I would suggest that you understand margin and that you use it to a level that you're comfortable with. And again, you can borrow from within your brokerage against your funds. You can buy leveraged funds. Neos has one, XQQI, that just came out. TDAX is the Tap Alpha version. Those are the two that I buy in a big way. And then I also buy Hui from time to time, HOOW. I buy that one because I'm very familiar with Robinhood's financials and the valuation metrics. And I watch the stock Hood. And when I think it gets too expensive, I sell it. I don't care if I sell it at the top. I care that I have made money. And when it drops like it has these last couple of weeks, it's down, I think, slightly more than Bitcoin. Bitcoin or cryptocurrency is only 20% of Robinhood's revenue. So you're telling me I'm going down percent for percent on something that is only 20% of Robinhood's business, while they've increased their margins, while they've gotten into the predictive markets, and that could go away and there's risk there. But dollar for dollar, Hood went down way more than it should have. And so I bought the leveraged fund. And so, again, just to wrap this up, please like and subscribe to the channel. I always forget that part if you find this interesting. But if you're into quality, high-yielding income ETFs and funds that are also high-yielding, I think understanding and using leverage isn't optional. I think it's required to actually do your job for yourself in the future. So thanks for tuning in, and have a good day.